why your ETF portfolio isn't growing, and how to fix it. All right, let's be honest here. You did the sensible thing, right? You bought a few exchange traded funds, you set up the automatic buys, and you promised yourself you wouldn't fuss with it. You were going to be disciplined. Yet every single time you check your account, and come on, we all check more than we should, the line looks stubbornly flat. Meanwhile, your feed keeps shouting about markets pushing higher, everyone else seems to be winning, and you're sitting there wondering what the hell is going on. It's frustrating. I get it. It can feel like you missed a class everyone else attended, like there's some secret handshake you don't know about. But here's the thing, you didn't miss anything. What's happening is actually quieter, more ordinary, and completely fixable. A handful of small leaks, tiny ones, are slowing your compounding and keeping your portfolio stuck in place. And today, we're going to find those leaks, we're going to plug them, and we're going to rebuild a plan that actually moves. Here's a stat that might sting a little. A whopping 70% of self-managed ETF investors actually underperform the very indexes their funds are supposed to track. Think about that for a second. It's not because the funds themselves are broken or because the market is rigged against you. Nope. It's usually because of a few tiny, almost invisible leaks that over time can sink your entire investment ship. They're easy to miss, but they're absolutely critical. Stick with me and we're going to find every single one of those leaks and plug them up for good. Okay, let's dive into the first big one, closet overlap. This is super common, especially for beginners. You feel like you're being smart, right? You grab 3 ticker symbols that sound different, maybe an S&P 500 ETF, a flashy top 100 growth ETF, and then a total market ETF for good measure. You high-five yourself thinking, nailed diversification. But hold on a minute. Have you actually checked what's inside those ETFs? Here's the kicker. If you pull up the holdings for all 3, chances are you'll see familiar names like Apple, Microsoft, and Nvidia appearing in all of them. What you think is diversification is actually just triple paying fees to own the same exact stocks. It's like buying 3 different gym memberships, hoping you'll get 3 times fitter. You won't. All you're doing is paying more for the same access. This kind of hidden overlap silently drags down your performance, eating away at your returns without you even realizing it. It's a silent killer for your portfolio's growth. So how do you fix this sneaky problem? It's surprisingly simple. Before you hit that buy button, head over to any free fund screener website. There are plenty out there. Find the portfolio or holdings tab for each ETF you're considering. Copy the top 5 or 10 largest holdings and then paste them side by side, maybe into a simple spreadsheet or just Notepad. If the same dominant names keep popping up across your selections, you've found your overlap. The solution? Pick the broadest, cheapest option among them and move on. Seriously, one broad US market ETF with a tiny 0.03% expense ratio will almost always beat out 3 overlapping funds that are each charging you 0.15%. You're paying for simplicity and efficiency, and your wallet will thank you for it in the long run. Now, this one's a bit more nuanced, but just as important. We've all been there, bragging to our friends about how we shaved 0.05% off our expense ratios, feeling like a financial wizard. And yes, keeping fees low is absolutely crucial. But here's where most people get blindsided. They ignore the trading spread. What's a trading spread? It's the difference between the highest price a buyer is willing to pay, the bid, and the lowest price a seller is willing to accept, the ask. If the ETF you're buying only averages, say, 12,000 shares traded a day, that bid-ask gap can easily nick you 0.3% every single time you buy or sell. Let's put that into perspective. On a $10,000 position, that's $30 lost before you even blink. That's equal to 6 years of the 0.05% expense difference you were so proud of saving. It's like focusing on finding the cheapest gas station while ignoring the fact that your car leaks fuel. This friction adds up, especially if you're making regular contributions. The fix here is straightforward. Stick with tickers that are trading over 1 million shares daily, unless, of course, you just love donating your hard-earned money to market makers. Before you hit buy, type in that ticker symbol, quickly check its average daily trading volume and only proceed if that number is comfortably in the 7 digits or higher. High volume means high liquidity, which means tighter spreads and less money needlessly lost. It's a simple check that can save you a surprising amount over time, ensuring your money is working for you, not for someone else's trading profits. All right, let's talk about a very human tendency, home country worship. It's especially prevalent among US investors who often run portfolios that are 85% domestic. And you know what? For the last decade or so, the US market has absolutely crushed international stocks. So it's easy to think, why bother with anything else? It feels safe, familiar, and it's been performing well. But here's the cold hard truth. The next decade often flips that script. History is full of examples. Remember the 2000s? From 2000 to 2009, the MSCI EF index, which tracks developed markets outside North America, actually doubled the S&P 500. Think about that. Ignoring the other 45% of the global market capitalization isn't just a slight oversight. It's essentially betting your entire financial future, your whole nest egg, on one single jersey. It's putting all your eggs in one basket, a basket that, while great right now, might not always be the top performer. True diversification means looking beyond your borders and embracing the global economy. Don't overcomplicate this. You don't need to become a global economics expert overnight. Start simple. A great foundational mix often looks like this: 60% US total market, 30% international developed markets, and 10% emerging markets. The beauty of this approach, you can usually achieve this with just one ETF per sleeve. This mix captures the vast majority of the world's investable assets, inherently lowers your overall portfolio volatility, and here's the best part: you can rebalance it once a year in under 10 minutes. It's a powerful way to ensure you're not missing out on the next big global growth story, wherever it happens to be. If these first 3 mistakes and their fixes have already clicked with you, and you can see how they might save you $1,000 or more, do me a quick favor. Hit that like button. Seriously, it helps YouTube show this video to the next person who's feeling stuck with their portfolio, and we all want to help each other out, right? And if you're hungry for more, specifically the exact 3 fun pie I actually give my own coaching clients, I've put a free link in the description. It's super cool because it auto builds the portfolio for any brokerage. Go check it out. All right, let's tackle another common pitfall: dividend tunnel vision. Dividend ETFs feel incredibly safe, don't they? Money just shows up in your account like clockwork. It's reassuring. But here's the thing: a 3% yield with 2% principal erosion, meaning the underlying value of your investment is slowly shrinking, nets you far less than a growth ETF that pays nothing but appreciates by 8% year after year. Worse yet, those juicy dividends are often paid out by the same mature, established companies whose growth curves look more like a flat line than an exciting upward trajectory. They're like a can of soda that's been sitting out too long, flat. Chasing income today, particularly if you don't actually need that income for living expenses, often means starving your portfolio of capital gains tomorrow. You're trading potential explosive growth for a steady drip, and for long-term investors, that's usually a bad trade. Ask yourself a fundamental question: why am I owning this? If you genuinely need immediate cash flow to pay bills or supplement your income, then a dividend-focused strategy makes perfect sense. No judgment there, but if you're investing for long-term growth and wealth accumulation, then tilt your portfolio toward total market funds. These funds automatically reinvest their earnings, allowing your money to compound efficiently without the drag of yearly taxable distributions. You want your money to be working as hard as possible, and for most long-term investors, that means maximizing total return, not just chasing a dividend yield. This one is subtle but powerful: rebalance amnesia. A portfolio that's left completely alone will naturally drift into whatever asset class happens to be hot. Think about it. Tech stocks surged dramatically post 2020. If you started with a sensible 60% stocks and 40% bonds allocation and then just ignored it, you might now be sitting near 80% equities. That means your risk level has almost doubled without you making a single conscious decision. Here's the scary part. The worst market crashes almost always happen right after investors have completely forgotten to rebalance, letting their risk exposure balloon. When the market inevitably corrects, you're hit much harder than you should be, simply because you let your portfolio get out of whack. Rebalancing isn't just about maintaining your desired risk, it's a built-in mechanism to buy low and sell high. Make rebalancing a non-negotiable habit. Pick a specific memorable day each year, maybe your birthday or tax day or New Year's Day, and mark it on your calendar. On that day, run the numbers. See which asset classes have grown beyond their target allocation and which have fallen behind. Then you simply sell a bit of what's gone up, selling high, and buy a bit of what's gone down, buying low. Get each fund back within, say, 5% of its target allocation. Set a phone reminder, put it on your fridge, whatever works. This single simple habit has historically been shown to add 0% to 0.5% to annual returns, and it requires zero forecasting skill. It's pure discipline, and it pays off big time. Everyone loves the heartwarming story of the steady monthly buyer diligently investing the same amount month after month. It's a fantastic strategy. Dollar cost averaging is powerful, but too many people skip the crucial second act of that story, actually raising the amount you contribute. If your monthly contribution has stayed flat since, say, 2019, inflation has quietly trimmed its purchasing power by a significant chunk, easily 20% or more. This means the money you think you're putting to work is actually shrinking in real terms. Your account balance might be growing, but it's growing slower than it could be because the real value of your contributions isn't keeping pace. You're essentially running in place, and inflation is the invisible treadmill speed adjuster. This is probably one of the easiest and most impactful fixes. Automate a small, consistent increase to your contributions every single January, even just a 5% bump. Most people barely feel a 5% pay cut to their monthly discretionary spending, but that small increase, compounded over years, makes a massive difference to your portfolio's growth trajectory. Your future self will absolutely high-five you while sipping a fancy drink on a beach somewhere, because you set up a system that ensures your money always keeps pace, and then some. Okay, this is where things can get really messy really fast. We're talking about performance chasing, specifically with leveraged ETFs. Triple leverage NASDAQ ETFs, for example, can look like absolute heroes during a raging bull market. They promise to magnify your gains, and when everything's going up, that sounds fantastic. But here's the brutal reality. They can also create a 30% in a single week. And worse, they suffer from something called decay, because these funds rebalance daily to maintain their leverage. Even if the underlying index goes up and down but ends flat over a period, the leveraged ETF will likely lose money. They decay like unrefrigerated fish. You'll see retail forums cheer on the massive upside, but they quietly delete posts when volatility rips their investors' faces off. These aren't designed for long-term holding. They're trading instruments, pure and simple. This one comes with a very firm, non-negotiable rule. If you can't explain precisely how the fund rebalances overnight or how daily compounding affects its long-term performance, you have zero business holding it. Period. Just don't do it. Replace any of these speculative, high-risk instruments with plain vanilla, broad market index funds. Seriously, you'll sleep like a baby knowing your money is growing steadily and safely without the constant threat of a catastrophic loss. So, after all that, are you ready for the absolute simplest, most effective portfolio blueprint that definitely dodges every single mistake we've just covered? It's not complex, it's not flashy, but it works. Here it is, a total world stock ETF. This is your one-stop shop for global equity exposure. We're talking one ticker symbol, 12,000 different stocks from around the globe, usually with an incredibly low 0.07% fee and deep liquidity. It captures everything. A total US bond ETF. This acts as the ballast for your portfolio, smoothing out the ride when stocks get bumpy. It will have an even lower fee, something like 0.03%. An international ex-US ETF. This one ensures you're truly diversified globally, specifically capturing all the growth outside of the US that your total world stock ETF might not fully emphasize. Or if you prefer a bit more control over your international allocation, think of it as rounding out your global footprint. It might come in around a 0.08% fee. How do you put it together? A great starting point is to weight them roughly 60% equity, combined from your total world and international ex-US if you use both, or just total world if you simplify even further. 30% US bond and 10% international equity. Rebalance annually, turn on auto invest, and then honestly, just ignore the news. Historically, this kind of balanced low-cost blend returns within 0.1% of far more complex, actively managed allocations, and it takes you maybe 15 minutes a year to manage. That's it. Look, your ETF portfolio isn't failing because the market is rigged against you or because you're somehow bad at investing. It's failing because tiny, often overlooked frictions are quietly ganging up on you, eroding your returns little by little. But now you know better. You're going to kill that closet overlap, ensuring you're not paying extra for the same stocks. You'll mind the trading volume, not just the expense ratios, to avoid hidden costs. You're going to diversify globally because the world is a big place and opportunities pop up everywhere. You'll quit worshipping dividends if they don't align with your long-term growth goals. Rebalance yearly, like clockwork, to keep your risk in check and consistently buy low, sell high. You'll raise your contributions with inflation, ensuring your money keeps its purchasing power. And please, for the love of all that is financially sound, stay away from leveraged funds you don't understand. Do those 7 things, and I promise you, your investment graph will start looking exactly like the long-term line you always wanted to see: quiet, steady, and relentlessly upward. Drop your questions below. Check out the next video on my top 3 ETFs for 2025. And remember one crucial thing: slow money is still money, especially if you finally stop leaking it.